I'm Sankalp and I represent the business development team at PMS AIF WORLD. And for those of you who have been following us, you would know that we have always talked about informed investing, and at every stage of the market rally or the market downfall, we have had special guests who come and talk about what's their view on the market, what's their take on the market, and we try to find some sense around the market. And in that tradition ahead, we have a very special guest with us, Mr. Tejas Gutka. He is the fund manager at Tata AMC PMS division, and he has had 2 decades of investing experience. He's a very informed investor and a very kind of a on the point kind of fund manager we have with us today. And Tejas, before I hand over the floor to you, I just ran a poll which says market at tops ? 60% feel yes and 40% feel no, that there's still some headroom to go. So we have called this webinar or this call in specifically addressing the theme of a continued bull run or a breather or a time correction or something like that.
Right.
So it's a mixed audience that we have. Okay. So now 57% feel no, that the market still could see some more
some more
rise.
Right.
Yes.
Right.
So you have you have a mixed audience here who have mixed views. So up to you. Let's see what you have to say to us today. We invite question and answers from the audience as always. Over to you, Tejas.
Right. Thanks so much, Sankalpo. And hi, good evening, everyone. Thank you so much for being here today. Firstly, here's wishing you all a very happy new year. Coming to the agenda, there's a 2-point agenda for the presentation today, as you can see on your screens. We'll talk about what will markets do in 2021 and what should investors or how should we all kind of position our portfolios. Now, so let's start with the first part. Now, this is a very usual practice in the stock markets that at the beginning of every new year we try and build an outlook and devise a strategy for the new year, and then we'll try and position our portfolios at the beginning of each year. This year is even more special given that we're coming out of an extraordinary year where we saw some pretty sharp volatility, as well as I think something that most of us have probably witnessed only the first time in our lives, which is a global coordinated shutdown of the entire world economy, right? So, given this backdrop, I'm sure there are a lot of questions on investors' minds, questions like, will the markets mean revert from here or will momentum continue? So is a correction due or is this a good time to add to equity risks? Which segment will do well from here, large caps or mid and small caps? What is the extent of returns that we can expect from here? Which sectors will do well over the next decade? Which sectors or what funds to invest in? Should we concentrate? Should we diversify? And so on and so forth. Now, as I try and answer these questions, right, before we look ahead, I just want to sort of bring across a few data points from the past, which will kind of make this entire exercise of trying to look into the future, into perspective. What this slide shows is a pretty interesting data. This is basically the last decade's returns from the various asset classes in India. So these are INR returns of gold, equities, and fixed income, right? So some pretty interesting readings in this chart. Firstly, gold outperformed equities. Second, within equities, large caps outperformed mid and small caps. And third, that the risk premium or the spread between equity returns and fixed income returns was pretty low. Typically equity market risk premiums range from about 4 to 6%, but if you see the last decade, they've been about 1.5 to 2.5%. Right now, what I find interesting about this is that at the beginning of last decade, no one was really talking about this is how the decade will pan. That gold will probably be the best performing asset classes. Equities, will kind of be somewhere in the middle, and there will be very little risk premium that you'll earn by investing in equities. I think most of us will remember 2010 as a pretty bullish year that started the decade, and I think all of us were quite sanguine on the equity markets. Now, this is 10 years is a pretty long time. Even if you look at the last 1 year, I don't think any outlook around this time last year mentioned that, we're going to have extreme volatility in the market. We'll first hit all-time highs, then correct sharply, and then probably from the bottom double over a period of 9 to 10 months. I don't remember reading anything like this, and I'm sure none of you all would have also read anything similar, right? So, the point that this drives is that as far as markets are concerned, nobody knows what's going to happen, right? The future is both unknown and unknowable. And I'll give you a few more examples, right? You remember 2016 US presidential elections, and there was so much chatter that, if Donald Trump becomes the next US president, then, markets will crash because the guy is crazy. He has some wild policies and so on and so forth. This happened again in 2019, where we said, if Joe Biden becomes the president, he's going to raise taxes, which is not good. The wealthy are going to be suffering, and therefore, people will take out money from risk assets, stock market will correct, so on and so forth. And none of that transpired. In fact, after both of these elections, we saw some pretty good rallies in equity markets, right? So again, what this shows is that, trying to forecast the future direction of the market is a futile exercise, right? The stock market is a place where both momentum as well as mean reversion can be observed in quick successions with each other, right? Now you may say that's all well and good, but currently the markets are at an all-time high, and therefore, does this situation make it different? Well, here's an interesting data point that I was looking at recently. There is, and this research says that there's only a 5% chance that you're going to buy an asset at its best possible price. Okay, this means that there's a 95% chance that you will buy it a little too high relative to some lower future price, right? Does this imply that you should not buy at all-time highs? No, absolutely not. And the reason is what this chart indicates, right? This is the chart of the Indian equity markets from 1991. The areas highlighted in reds are the times that the markets have been at an all-time high, right? So the market never hits an all-time high and then corrects immediately, right? The momentum kind of continues. You see newer all-time highs being formed, and then the momentum continues. Over the medium term, we may see mean reversion and market correction, but it is definitely not an immediate term phenomenon. More importantly, what this chart also shows you is that sometimes this momentum can go on for as long as a year, and sometimes as short as a few months, as we saw in January, where you hit an all-time high and within a couple of months you saw a pretty sharp correction. But if you look at history, there have been periods where all-time highs have persisted for a very, very long time, which means, again, history tells us that there is no science, there is no data that will tell you that just because the markets are at an all-time high, which that means that a correction is due, and therefore there is no there is no way that we can be sure what markets will do next from here on, right? Now, the other thing that I want to talk about is typically this in equities we kind of look at this and say that if I can avoid the downside, or if I can protect my downside, then I can enhance my return. Now, here's some data again that I want to kind of run through. This is basically, we've looked at 25 years of data of Indian equities. The 25-year CAGR in India has been about 11.5% on the Sensex. What we've done here is, in this exercise, we said, what happens to this 11.5% CAGR if you miss any 1 year's returns, right? So let's say at the beginning of each year, you are deciding whether, do I want to be invested in equities in this year or not? So you build an outlook for this calendar year, and then based on that outlook, you decide either to remain invested or to completely stay out of the market. So if you stayed out of the market in a year like 1996, you would have enhanced this CAGR by a minor 5 basis points. On the other hand, if you stayed out of the market in a year like 1998, you would have enhanced this 25-year CAGR by about 1%. Right, and that's how the chart reads. So if you were out of the market, let's say in a year like 1997, then you had to have reduced your CAGR by about close to 1%, right? So what the green bars indicate are years that you were out of the market and the market corrected. The red bars indicate that you were out of the market, but the market rallied, right? And two interesting data points that I want to draw your attention to in this slide. First being that, the number of green bars are far lower than the number of red bars, right? What this tells you is that in general, the market is always in an uptrend, and there are very few years where the market is in a downtrend, right? The typical ratio is about 70-30. 70% of the time prices are rising up, 30% of the time prices are falling down. More importantly, if you compare the length of these red and green bars, you will see that the red bars are typically on average much taller than the green bars. Okay, what this tells us is that the amount of CAGR that you can enhance by staying out of the market is much lower than the opportunity loss that you will incur by staying out of the market in a year that the market rallied, right? So the point being driven here is that the odds are not in your favor to time the markets, right? First, the probability of a market fall is much lower, and B, the reward that you will get by timing a market fall is much lower than the opportunity loss that you'll have because you missed a good year in the market, right? So all of this, all of these slides kind of indicate that what the market has a mind of its own, right? These annual outlooks and these trying to look forward into the market and trying to devise your investment strategies, this kind of doesn't help you enhance your returns in any ways. What does enhance your return, in my view, is actually staying invested through the market, going through the ups and downs, but staying invested, and that kind of gives you a reasonable sort of a long-term return on your investments, right? So this is where I think we move to the second part of the presentation, which is where you would say that, okay, maybe timing the market is not that great a strategy, but how do we devise a portfolio that can navigate through these markets, both through the up years as well as through the down years? The answer to that is something that we all know, but we often forget, and that I think is largely the second half of this presentation. And since we are a cricket-loving nation, I thought it would be apt to use a cricketing analogy here. There's a lot that investors can learn from the way your a cricket squad is picked up by the selectors, right? No matter what country you're playing in, no matter the kind of conditions you play in, there are certain minimum requirements of every cricketing team, right? So you'll have a wicket keeper, you'll have a few batsmen, a couple of all-rounders, a few bowlers, and that's how you form a team. At no point in time will you go with a team. So, for example, if you were going on a batting track, you won't go with a team that is only batsmen and no bowlers, or one or two bowlers and the rest being batsmen, right? At all times, you will try and balance bowlers, batsmen, all-rounders, wicket keepers, and so on and so forth. Within these categories, you may move your weightages up and down, but largely you will try and maintain a fair balance. And I think that is what we need to learn as equity investors, that one of the best ways to stay invested in the markets, one of the best long-term strategies to make money in the markets is diversification, right? Diversification across asset classes, across geographies, across market capitalization, across investment styles, etc., is one of the best tools that an investor has in his hands to kind of generate the best long-term risk-adjusted returns, right? And in talking about investment styles, right, if you look at the market at different points in time in the market, different investment styles work, right? You had the last 10 years, well, growth and quality was the flavor of the market. You had a period when growth at a reasonable price, which was, I think, the early part of the last decade, where growth at a reasonable price was the flavor of the market. In between, you have a mean reversion phase where, market will kind of correct, valuations kind of come off. And early part of the 2000s was when you saw a lot of value being traded in the market, or market favoring a lot of value kind of stocks, right? So now here, once again, one doesn't know at what period which style is going to work, and therefore, as you are building diversification in your portfolio, it probably makes sense to diversify your portfolio across these styles, right? And largely that is the thought that we had in mind when we devised a strategy which we called internally as our ACT investment approach, which is ACT basically is an acronym for all weather stocks, catalyst for growth, and turnaround candidates, right? So as you would have guessed, this portfolio consists of three different segments, each representing one of A, C, and T. All-weather stocks, as the name implies, is basically your typical compounders. These are companies that can exhibit consistent profit growths, that can reinvest their profits to further their growth agendas. This portion forms the foundation of our portfolio. It is about 40 to 50% of our portfolio would rest in all-weather stocks. Next, we would look at some catalysts for growth. Think of these as slightly cyclical businesses that that are currently suffering because the cycle is not in their favor. But the expectation is that in the next 12 to 18 months, the cycle will turn in favor and these businesses will do well. Some of the best examples of these kind of businesses, are interest rate sensitive sectors. So think about automobiles, think about banking. These sectors kind of the growth rates in these sectors kind of tend to move a little up and down over the long-term average based on how interest rates are behaving. So 25 to 30% of the portfolio is allocated to these kind of stocks. And the remainder of the portfolio, which is another 20 to 25% of the portfolio, is allocated to turnaround candidates. Now, these are largely businesses that have had a long period of suffering, either because of some internal factors like operational inefficiencies or management that didn't pay attention a lot to or capital allocation decisions that went wrong, or through external conditions, which is macroeconomic challenges or hyper competition that the industry saw. These are businesses where we think that over the next 3 to 5 years, these businesses will see improvement in their conditions, and therefore there is an opportunity to make outsized returns in these businesses. So for example, if you look at telecom, right, this is an industry that suffered a lot of competition and lost its pricing powers. However, if you look at the last few years in telecom, the industry is consolidated well now, to the extent that now it's a 2.5-3 player industry. The players have started talking about price hikes. We've already seen a couple of price hikes, which means that pricing power is coming back to the industries, and therefore the expectations is that over the next 3 to 5 years, the ROEs and the ROCs of this industry will see significant improvements, right? So those are the kind of bets that we would like to take within the turnaround segments. Now, here, we are cognizant that not all turnarounds actually turn around. There are a lot of value stocks that kind of end up being value traps. And therefore, to manage the risk of the portfolio, we try and diversify our turnaround investments across about 8 to 10 names. This ensures that no one name is a very large part of the portfolio. The risk is diversified across a reasonable amount of names across industries. And even if 3 or 4 out of these 8 or 10 names actually manage to turn around, the returns are significant enough that they will cover up for the opportunity lost of the other turnarounds not turning around, as well as they'll add to the overall portfolio return. And something, as I mentioned, telecom is a great example. It's been part of our portfolio since inception, and we've seen some fairly strong returns from these segments. A couple of auto ancillaries were also part of this segment, and we've already seen more than 100% returns from these kind of names. So like I said, 3-4 stocks turn around, the returns can be so big that they'll help you enhance the overall returns of your portfolio. So this is the process that we had when we thought of diversification. We said, let's not just diversify across industries and across market caps, which is how you will typically look at a diversified multi-cap portfolio. We've added a nice little flavor of playing playing 3 segments of the market, which is high quality growth, cyclicality, as well as the value segment of the market, and that's how we've diversified our portfolio. Obviously, this diversification has played very well, and I think one of the best ways or one of the best times to test this diversification was the year 2020, where we saw a lot of volatility in the market, and as you can see on this chart on the right hand side, some interesting things happened as the COVID-induced lockdowns led to the meltdown in the market. So while the market was correcting, we had the A part of our portfolio, which is the compounder in our portfolio, that really rallied amidst the falling market, and that really helped us kind of bump up our returns in a falling market. Once the market hits bottom and as the recovery started, the IT pharma part of our portfolio participated very well, and which was largely the C part of our portfolio, that saw a pretty sharp recovery. Somewhere in the middle, while one single stock kind of drove the entire index, we had the turnaround candidates kind of do very, very well, and then in the last leg of the rally, we kind of saw a pretty significant alpha generated because both C and T part of our portfolios kind of really picked up, which is when markets kind of recognize that there is a cyclical recovery underway, and therefore all these cyclical stocks kind of really shot up, and we benefited. So if you see, despite all the volatility that we saw through the year, despite the quite narrow moves in terms of sectors that we saw in the market, our portfolio did reasonably well, delivered a 200 basis points alpha over the index on a TWR. So on an aggregate basis, obviously client portfolios would have done slightly better. TWR obviously gets impacted because of inflows and outflows, but on an average, we've kind of delivered a reasonable alpha. We had a year that went very well for us, and this kind of proves the point that diversification is a much better and simpler way than trying to understand what the market is going to do, and then tilting your portfolio to different market moves, and some years will go right, some years will go wrong, but the net impact is that you don't add too much to your returns. We think that this is a much simpler way of trying to navigate choppy markets as well as sideways markets, and so that's largely the talk that I wanted to talk about. To quickly sum it up, I think here's my humble advice to you for the year 2021 and beyond. Stop chasing market outlooks and expert opinions. Nobody has an idea of what the market is going to do. History is replete with examples where market has its own head and done its own things. It pays to remain invested even through corrections, because over the long term the markets kind of go up way more than they go down, and therefore one of the best investment strategies that you can have is to remain invested. You can obviously trim and increase your exposures as valuations move and up and down, but moving in and out of the market is definitely not a strategy that works in the long term. And lastly, seek reasonable diversification. At different points in time, different themes, different sectors, different styles work in the market, and therefore if you have a portfolio that is reasonably diversified across sectors, across styles, and has reasonable representation from different themes, then you will do very well over an extended period of the market. Now, you may say that all of this sounds a little too simple, but my humble submission to you is that all of investing is simple, but not easy. It's simple because there are very few, time-tested principles that kind of help you generate long-term returns, and some of the principles are listed here on this slide. It's not easy because time and again the markets will test you on your conviction in these principles. It will offer you opportunities that seem too tempting to sort of give up on one of these principles. But as we've seen through a number of charts here, that each time that you decide to give up on one of these principles, the market has only punished you, but not rewarded you. The way I like to think about this is that, as investors, there's a famous Indian story of Vikram and Betal. And the way I like to think about this is that as investors are like the King Vikram, whereas market is like Betal, right? And as you are trying to tame the market will offer a lot of stories. And as soon as you decide to respond to the market, Betal kind of flies back to its banyan tree, and you have to, all the hard work that you've done is gone down to dumps, and you got to start all over again. So that is how I think investing is simple, but definitely not easy, right? So that's the end of the presentation. Thank you so much for patiently listening, and we can open the floor to questions now.
Thank you, Tejas. Panditji, I'll request you to please stop sharing the screen. So another thing is that we ran a few polls. So Tejas, I'll come to it. So sure. Before that, let me just ask you this question, which I have. This is a personal question, since I saw this morning that sure. Elon Musk is now one of the wealthiest person on the planet.
Right.
So that makes me think a bulk of his wealth is through his company's valuation, which has gone close to 750% higher in this last 1 year.
Right.
And Tesla is still a company which is still a hope, trade, which is still at a nascent stage, and has not yet turned in profits, if I'm not wrong. So do you think investing is changing? I mean, for that matter, investors are now more welcoming of ideas. Investors are now more welcoming to invest in products that are more out there, more tech oriented. Even even if they don't earn anything to the company right now, but shareholders see some value in owning these names. Can we have such examples? A lot of these examples. Snapchat was another such examples. So, like you said, investing is
Right.
simple but not easy. So, I mean, I can't comprehend this part. And any thoughts on this?
Sure. So let me let me give you a slightly longish answer, right? If you study the history of markets, right, there are as time changes, the preference of the market changes, right? So when you have Benjamin Graham and the early years of Warren Buffett, right, the markets kind of favored book value as a measure of the valuation of companies. So Ben Graham was famous buying companies at low price to book value multiples. Then the second half of Buffett's career, and the time that investors like Charlie Munger or for that matter Phil Fisher, during their career, markets moved on from price to book to price to earnings, right? So book value kind of shifted to earnings, and then towards in the last few decades now, market has shifted preference from earnings to cash flows, right? So and I think the best example of this is Amazon. If you look at Amazon's rise, Amazon's never reported very high profits or profit margins, but the cash flows have been tremendous, and that's how shareholders have rewarded companies like this. It seems that this trend is changing again, and we are moving to price to sales as the metric. But I feel it's too soon to kind of decide if this is a trend to stay. Market also has a tendency to kind of take one idea to an extreme, and we saw that during the tech boom, where
17 rally also, something like that.
I mean, different times, right? The tech boom said that if your company had IT in its name, it was valued at crazy valuations, right? Price to eyeballs and price to clicks on your website and visitors on your website and so on and so forth. But these are short-term trends that kind of fancies that keep coming and going. I think part of the reason that you've seen a lot of valuations move up in some stocks is also because you've had a lot of momentum chasing investors in the market right now, right? I mean, there's a very interesting article that said that if you look at the US, the average savings rate in the US is about 7%, right? Most of them save too little, and half of them kind of live on credit card debt. But if you look at post the pandemic, the savings rate in US has shot up to about 33%. So people have stopped going to Las Vegas and Miami and Florida and so on and so forth. So the tourism is down, and people aren't spending as much money as they were pre-COVID. Where does this 33% saving goes, right? I mean, it would go to banks, but then you're not earning any interest there. Although bank deposits have kind of risen, which means part of that money is gone there. But if you look at other research, then something similar that happens in India has happened in the US, and which is that the margin trades have really shot up in the US.
Right.
So volumes in FNOs have gone up, broker margins have kind of shot up, right? Which means that there's a lot of fresh money that moved to the equity markets. Now you could build a lot of theory saying people have no work, people are sitting at home, they need entertainment. All right. So like I was saying, right, I mean, different things work in the market. I think there are a lot of IT stocks that have or tech stocks rather that have great cash flows, and despite the run up that we've seen in last year, trade at very, very attractive cash flow yields. They are not in bubble zone. I think in any kind of market scenario, there will always be one or two stocks that kind of get traded to the extreme, and I think that's the case with companies like Tesla, where I think the metric probably being talked about is a price to dream metric or something like that. But I don't think that's that's an all around kind of bubble that sits here.
Right. So that's a very unique answer, and I think it's a unique question as well. Nobody knows what's happening there.
Correct.
So now I would like you to take some time as we talk about a very important aspect for investors. So you say enough fund you expect to diversify on the basis of investing themes as well, apart from maybe market cap or sectors. So
Right.
this is a typical active kind of a management. That is, any alpha or any return that comes, absolute or relative, comes due to can be attributed to your activities in the fund.
Right.
So in the decade ahead, if you see, we towards the end of this decade also we have become top heavy. Okay. And then again, in the number of stocks that participate even from the broader market, there are few. So
Right.
will you be able to generate as a fund manager, staring into the new decade, will you be able to comfortably say that there's significant alpha that is going to come through your active management vis-a-vis an investor just sticking to the basics and paying, investing in an ETF? So
Right.
what are your thoughts on that?
So again, see, our market has not been as polarized as something like the US. If you look at the US, the S&P 500, I think 5 stocks have driven the entire return of S&P 500, right? 495 stocks haven't moved really, and this is data about a couple of months old, but I'm sure the big movement hasn't come in these 495 names still. And despite that, there are funds that have delivered pretty handsome returns over a period of time, right? So I don't think that the alpha, the opportunity to generate alpha has gone away. However, I think alpha is something that needs a slightly more nuanced understanding. I think the way investors look at alpha is on a year-to-year basis, and you kind of seek alpha every year. That may not be the case. I mean, as we look, I mean, see, market does its own things, right? So you could very well have 2 or 3 bad years and still end a 5-year period with a reasonable alpha. One of the ways that I like to look at markets is that is the 2008 period, right? If you built a portfolio in 2008 at the peak of the market, and you built another portfolio at the bottom of the market, right? At the peak of the market, you went and bought high quality stocks, which were trading at crazy valuations already. At the bottom of the market, you went and bought all the stocks that were darling of the markets, right? So your real estates, infra names, and so on and so forth, which were trading very, very cheap after the 2009 correction. And if you ran this portfolio over a period of, let's say, 8-10 years, you'd be surprised to know that the high quality portfolio not only gave you positive returns but outperformed the market. On the other hand, the low quality or the cheap portfolio not only underperformed the market but actually didn't make you a lot of money, right? This is to say that market in different times, different things work in the market. If you remember, when the decade started, the entire focus was in these infra and real estate names, and in fact, they kind of rallied in the first half, in the first leg of the rally of the market. Quality kind of picked up only post 2013-14 is when quality really picked up and differentiated. So you had your initial years where quality didn't work as much as it would have through the decade, and you still ended the decade with very, very good kind of outcomes in quality. So alpha over a period of time can be generated by sticking to one strategy and is possible. Alpha on an annual basis is tough. Alpha on an annual basis is vanity. I don't think you should really chase it. I don't think that there is any way that any fund manager will consistently on a year-on-year basis try and will be able to deliver you alpha. If it does, I'm sure luck plays a lot of role. But if you have a 5-year horizon, if you have a 10-year horizon, I think India has enough opportunities, enough great businesses that will continue to kind of give you alpha. And there's this lovely Charlie Munger quote that says that if you focus on the kind of businesses that you invest in, and if you invest in very high quality businesses, and your investment horizon is, let's say, 20, 30 years, then at the end of that 10, 20, 30 years, your returns will mimic the returns that the business generates on its own capital, right? Which means that if you're buying a business that's giving you an 18% ROCE and you hold it for 8 years or 15, 20 years, then irrespective of your starting valuations, you will end up closer to 18%. You may not end up at 18, but you may end up at 15, 16, 17, 18 or 20, depending on the valuation that you bought it at. But each of these scenarios will give you at least at par or better returns than the market, right? And I think India offers you so many businesses today, where the ROCs are great, where the growth opportunity is high, which means that they can take the cash flows from these ROCs and reinvest for growth and kind of build scale over the next 8-10 years. So I think alpha opportunities are still there in the market. I don't think that alpha has gone away from the market.
Right. So to you would say that alpha also has to be looked at in terms of a more broader and a more deeper horizon, wherein year on year alpha might not be the best way to look at. Okay,
Yeah.
point taken. So another thing which I think is a theme of most of your advice or counsel to the investors is that you have to be a long-term investor.
True.
Okay, so we ran a poll while you were presenting, and we asked how many people held their stocks for at least 5 years or more. Okay,
Right.
जिस उन्होंने एटलीस्ट 5 साल वो एक कोई भी एक स्टॉक को होल्ड किया हो. So
Right.
50% said they did, 50% said they did not. So which means that if we take this cohort as a representative, and I'm sure this is a very informed and knowledgeable, cohort, we see that 50% of this cohort has never held a stock for more than 5 years.
True.
Okay. So what happens is that alpha is looked from a perspective of then a lesser period of time, or even returns are probably looked at or judged by a lesser period of time.
Yeah.
Okay. So my question to you is is Tata PMS as a fund house, as a house, cognizant of these facts, and how do you play the market in such times so that you meet these expectations of investors who represent at least the majority of the market?
Right. So look, when we talk about the long horizon, it doesn't have to be, long term in one stock or one business for that matter, right? What you're looking at is largely a pack of businesses and a certain investment strategy. And so long as you can stick to your investment strategy, you will get your alpha. The problem happens is that the market, will constantly test your investment strategy. And I'll give you an example, right? Let's look at 2020, right? And let's look at what happened when the recovery started. It started with a couple of sectors, right? It was extremely polarized, IT, pharma, and then you had one single stock kind of go 3x in a large weight, right? And that kind of drove the market. Now, a lot of people wanted to churn their portfolios and say, maybe banking is dead. So, and banking was a sector that was questioned a lot, right? And said banking is dead. Let's chase IT and so on and so forth. Now, that is a problem. When you start chasing something which is, the flavor of the market, and then you try and, find alpha, that is where the problem lies. The real way that you generate alpha is to riding through these down waves as well, right? I mean, banking was a laggard, but eventually banks caught up. Okay, today, banking funds have also delivered reasonable returns, or the banking index is up 40-50% from the low, which is not too different from what the overall market has done. So trying to jump trees in search of alpha is the wrong strategy, and that is where a lot of investors get hurt. There's a lot of research done by firms like Morningstar and a lot of other people, where they say that while funds deliver whatever they deliver, so for example, if a fund delivered an 18% CAGR over, let's say, a 20-year period, the investors never experienced this 18% CAGR, right? Their returns were 12% to 9% CAGRs. Why? Because they came into the fund after the good years and they left the fund after the bad years. And that's what I'm trying to talk about. That when you think of alpha, don't look at it as an every year phenomenon. You're going to stick with it. If you identified a good business, a good fund manager, or a good strategy, sit with it. Ride the volatility. You will be rewarded handsomely for riding the volatility. There is no reward for avoiding that volatility. While we all believe that, had I sold in March, I would have saved my portfolio going down 40-50%. I'd have re-entered in April and so on and so forth. But if you really talk to people, I think no one realized that, this is a new bull run that started in April, May. I think it was only in June, July that people realized, this probably is a recovery, because that is when businesses also started talking about reopening and recovery and so on and so forth, right? So you're never going to get your timing calls right, and which is what I want to. I mean, that's the point that I want to drive. That alpha doesn't come in by going in and out of funds, businesses, markets, and so on and so forth. Alpha comes in by sticking to your strategy, right? Stick to your strategy. Don't chase, what is the hot topic in the market, right? If you chased pharma, let's say post rally in May, June, July, August, pharma has actually been where it is, and you've not made any money in the last 3-4 months, right? So don't do that.
Right. So to say that your counsel to the investors then will be, if you have a strategy that you think is right, or a fund manager that is right, you stick with him, not necessarily with the same kind of stocks or so to say, but you stick to your core strategy, and that is what is going to make money. Correct. Okay, point well taken. So, we've got a question from Rushabh. Again, since you mentioned sectors, what are the three emerging sectors, according to you, the three or four, whatever you deem fit, according to you, in the next few years? And a word of caution to listeners today: this is not to be construed as a investment advice. This is more from the academic and knowledge perspective. So, over to you, Tejas, with that disclaimer.
Right. So, it's trying to find the two or three best sectors is like trying to build a market outlook, which is everything. It kind of goes against the presentation that I gave, and I'll tell you why. 2001, when the Twin Towers collapsed in the US, everyone said that airline is a dead sector. Air travel is going to go down because people are going to be so scared now. When the financial crisis happened, people wrote of banking saying, global liquidity is tight, banks are leveraged businesses, banking is the sector to stay away from. Infra, like I said earlier, was the darling of the market back then. And look what happened, right? So the decade of 2000 to 2010 probably saw air travel kind of go up manyfold, contrary to what people believed in 2002. Banking was the top performer of the last decade in India, despite people writing of banking as a high risk sector. Infra was probably one of the worst sectors in the market, despite people kind of loving infra and saying, if the India growth story plays out, then it has to be infra. So I don't think, again, that it makes sense trying to find that 1, 2, 3 sector and say, I'm going to be playing these sectors, right? If you understand a country like India, right, what are our strengths? I think one of our biggest strengths is our demographics, right? We have a huge percentage of our population that is in the working age, and we keep adding to that lot every year, which means that you have a high share of young population, who've just entered the earning phase, and who are the spendthrifts really. Which means that consumption is always going to be an evergreen theme in the country, right? Now, this consumption could be played through a number of sectors. It could be played. I mean, we've seen that two-wheelers. I mean, people have shifted from two-wheelers to four-wheelers. At some point, we'll kind of premiumize in the four-wheelers. Apparel retailing is probably one of the greater themes that has been talked about in the last few years, right? There's a lot of consolidation that we've seen in the jewelry sector, and we see, that there is a lot of importance that people are now paying to brands rather than knowing your own jeweler personally. So a lot of these minor themes kind of keep playing in the market, but at a larger this thing, I don't think it makes any sense to kind of tilt your portfolio to any one or two themes. Like I said, in 2009-10, there was no case that you could make against infra or real estate. And imagine if you had a portfolio that was heavy only infra or real estate, you would have suffered through the entire decade. So I don't think that that's the right way to approach your sector. But like I said, the overarching philosophy of any portfolio, if you see in India, I think consumption is a theme that will play a very, very big part in any of these portfolios, and that's where I think you got to keep your eyes and ears open. Consumption is a very wide sector, too many things that happen in consumption, and so you're gonna pick your picks from that wide array.
Right. So consumption is definitely one. You are more of the view that you should be wary of these things. You never know what happens in the coming years. Agreed with you. Businesses could change, and now that we're going to have a lot of emerging businesses, new listings coming up every month. Big companies, big brands. So the listed space is about to change, and sectors, never before sectors are also going to get listed. So if you name two now, you probably will tend to exclude those. Like insurance turned out, nobody was talking insurance, as late as 2015-16.
Correct.
Pick up DFC Life, pick up the other insurers. So many got listed.
Correct.
So point well taken. So what I'm going to ask you next is from the investor's perspective again. So a lot of times, when I talk to investors, I'm sure when you also talk to investors, a concern is around the fees per se, how it is charged. So while in PMS you have an option of charging or paying the fees in multiple ways. It could be flexible, it could be fixed, hybrid, it can be only performance fee. In mutual funds there is no such option. So again, to the benefit of investors, how do you view this? I don't intend to put you in a spot or so, but should investors or should fund managers be entitled to charge a performance fee only, or should they have a fixed management fee? Or if you have any other perspective to offer, Because it's a very widely asked question. Over to you.
So look, I'll tell you what, I mean, if you, just plot the annual returns over the last 10, 15, 20 years on an Excel and run two models where one is a fixed fee model, one is a fixed plus performance fee model, and so on and so forth. Now, different things will work well in different environments, right? Where the market doesn't perform too well, investors will prefer paying a performance-based fee because obviously you don't end up paying a lot of fee. But the problem with performance-based fees is that if you have a very good year, you're going to pay out a lot of money in that year as fees, and that kind of hurts. When you see a large part of your portfolio being taken out as profit share, and typically, a couple of good years, there will be mean reversion, right? So eventually you'll see a correction, and you realize that while a lot of profit share has gone out of your portfolio, eventually the market corrected and your value's gone down. So at that point in time, the investor may think that, no, I was better off with a fixed fee model because at least I knew how much goes out every year, right? So, like I said, at different points in time, different things work. If you chart a 15, 20 year kind of data in the market, both models will kind of give you similar results. See, end of the day, where has this 220 structure or, the 2.5% fixed fee or these things come from? These are decided by market forces, right? And market is probably smarter than collectively all of us together, right? And I think economics kind of caught up and market realized that this is where the average fee is going to be, whether you pay a lot of profit shares or you pay a fixed fee or you pay a hybrid model. End of the day, your cost for outsourcing your investments is in the range of about 1.5 to 2.5%, right? And that's the long-term range, right? So you could pick any model. You pick a 1% fixed fee and a 20% profit share, or a 2.5% fixed fee. Doesn't matter. You will end up at the same place eventually. You will have a 3-5 year period where one will look better than the other. But over the life of your investing journey, which is typically for most of us 20, 30 years, it will not matter so much.
Right. Thank you. That's a very intuitive answer, and I am sure investors will take a lot from this simple answer. And I answered this question in so many various ways, but I think you did the best. So thank you on that. So we'll take the last question. So the last question is more about what could be the factors from here that could be a breather. So when we, what our topic was, equities, a sustained bull run or a breather. So we talk about factors that could still ride the market to higher highs. But let's, because we have always maintained we are cautiously optimistic. So we have gone through the optimistic part. Now let's, we'll end on a cautious note as well. And as to how or what could be the possible reasons of breather. Will it be the budget for 2021? Will it be something else, or will it just be a technical thing? What do you feel? We'll take it from you.
Right. No, there's always room for caution in any market, and especially in a market like today, right, where valuations are not cheap, right? We're not in a 2013 market where valuations were at a bottom, and therefore you could say that I'm ready to bet a one-way rally from here. We are definitely not in that kind of a market, and therefore investors have to have an eye on factors that can kind of derail this rally, right? To my mind, from what I understand and from what I observe currently, I think if you look at one theme globally that is playing out is commodities, right? In the last couple of months, we've seen a fair amount of rise in prices of different commodities. These will eventually seep in to corporate numbers by way of inflation, right? And at some point will have an impact on profit margins. When you have a market where valuations are above average, and if profit margins kind of start dwindling, you will have valuations that will adjust for that, and therefore you could see a correction because of that. I think there was a glimpse that we got in 2000 and towards the end of 2015 and early 2016 when the entire taper tantrum started, right? And you saw the kind of volatility that came through in global assets. That is still not off the table because they've been, it's been years that you've been printing money. At some point you're going to stop, right? And it will be interesting to see how global markets react when you stop. I think the extreme case that I can build really to my mind right now is a combination of the two, where globally inflation picks up, and therefore the Fed and central banks say that look, we're done cutting interest rates, inflation is rising, it's coming closer to our comfort range, and therefore we are going to start tapering the money printing, and at some point hint at an interest rate hike. And it'll be interesting to see how things pan out when that first interest rate hike is indicated by one of these larger central banks, or even our own central bank at some point. And to my mind, that's something that I'll be watchful of, because
so you'll be cautious of inflation and the money running dry,
right?
So
right.
Just a follow-up question to that. Okay, what happens if there is status quo? Like, I'll just give you a perspective here. America cannot very easily just stop the liquidity push. American citizens are so angry that they stormed into the Capitol building. So imagine a situation where the liquidity runs dry. Similarly, the European government, the European Central Bank, or the European heads of states don't have much option. Japan has to keep supplying the money, to run things or to say. So what happens, if there is, however artificial it might be, they can maintain this status quo. What happens then? Do we look at a decade which we have never seen for equities or asset prices per se, or will, with the status quo being maintained in terms of the economics of interest rate and inflation, the returns will also somewhere stagnate? What happens then, if you have thought of an alternate like that?
So here's my answer. Look, if you look at the US market in I think the late 70s, okay, there was this whole talk that started about the Nifty 50 stocks, right? This has nothing to do with an index, but Nifty 50 was name given about 50 very high quality consumer names that were already trading at expensive valuations, and the general chatter was that if you buy these stocks and buy and forget these stocks, right? This is your retirement portfolio, these 50 stocks, P&Gs and Coca-Colas of the world, right? But there was a section of the market that said, look, these stocks are very expensive, and there is no way that we can make money by investing in these stocks. Over the entire next decade, so throughout the 80s, or at least up until about 85, 86, these stocks kept getting more expensive, right? So, it's something that I mentioned in the presentation, right? There is momentum and there is mean reversion in the market. You don't know what will play out when, right? You don't know which is a stronger force.
So we've got to have both.
In the long run, there will be mean reversion, but in the short term, momentum is a very strong force. But the short run, in the US at one point went in for over a decade. Then over the next 15 years, you didn't make any money out of these stocks, even though their earnings kept compounding, but the valuations were so high that you didn't make any money. But it took 10 years and then another 15 for this anomaly to correct, right? So never say never, largely.
Well, again, I've got to second you there, because I've just seen these stocks. Probably this is India's Nifty 50 movement.
Yes,
I'm not sure, but the coming times will tell. Again, it is a testament to fact that when troubled times come, people want to buy quality. People want to, they don't mind spending, or they don't mind overlooking valuations.
correct.
With that thought, thank you so much, Tejas, for being with us. Thank you, investors and our friends, for being on the call. We look forward to hosting you again, and I really enjoyed talking to you today on the show.
Thank you.
Very good insights to offer. Thank you, Tejas. Hope to see you again.
Thank you. Thanks. Bye-bye.